and we will get started. Thank you so much for joining me. My name is Erin Ellis, and I work for the Philadelphia Federal Credit Union. Tonight is part 1 of our credit webinar series, and I will be following up in 2 weeks with the second part of this. You can attend only tonight or only 2 weeks, and both will be great. So tonight we're going to focus on the introductory part of credit, building credit, and some of the sort of basics of the credit report. Next time on the 24th, we will be going a little more into managing debt. So maybe you have some credit card debt. What are the best ways to manage it and pay it off? So that's in 2 weeks. And tonight we're going to look at sort of the ins and outs of what makes up your score and what makes up your credit report. So this is a great place. Even if you have some knowledge of credit card, even if you have some debt, this sort of beginning phase is a really good place to be. For those of you here tonight who are like, well, this is great, but I'm already in this debt cycle, I want to know how to manage it, how to get rid of it, then please come back in 2 weeks. So you will need to register in order to get a link for that, because it's a whole different webinar. So I'm going to put the link to register for 2 weeks from tonight in the chat. So go ahead and register if you're interested in coming back in 2 weeks, and I would love to see you again. Okay, I'm going through housekeeping quickly. There is no chat feature available. However, if at any point you need to communicate with me, you can pop a question into the question box. So you should be able to see on your control panel an option for asking a question. So feel free to use the question to communicate with me any point during the webinar tonight. And if you are already registered for the second webinar, you do not need to register again. Great question. So if you registered for both of them at the same time, then you're good to go. Just want to make sure to catch anyone who didn't register for next time. Okay, great. And I mentioned, but I'll mention again, there are handouts attached, 2 PDFs, one of the resources and one of the PowerPoint slides. So you are welcome to access those at any time under the handouts on your control panel. And I will not be emailing those unless you ask for them. So grab them here. It's the easiest way to do it. All right, excellent. So we will get started. Just curious, is this your first time attending one of our webinars? So really quick, there's a poll that should pop up for you. So take a look at that and just click quickly yes or no, and then we'll move forward. Awesome. Great, and we're almost done with the poll. A couple more seconds. If you haven't clicked, click yes or no. Oh my goodness, 70% I'll share with you guys. Okay. So lots of yeses, so welcome back. I'm, thrilled that you're here again. If you are new, then welcome. All right, great. So let's get right into the meat of this here. Let's get right into it and start talking about credit. Okay. Oh, well, look at that. I'm sharing the wrong screen, but that's okay. And if anyone has questions about the registration later on at the end, I can answer that. My email will be shared too, and I can answer that as well. Trying something new with the closed captions tonight to make it a little more accessible for anybody else who finds reading a little easier. Sometimes the audio gets a little messy. So yeah, so trying something different, and hopefully it will be a good setup for folks. Okay, great. So a little bit about PFCU. Philadelphia Federal Credit Union, like most credit unions, we are not a bank. We are different because we are owned, credit unions are owned by our members. Usually that means that we don't charge as many fees associated with commercial banks. So this translates into the way we return our profits to our members. So it translates to, your no fee checking and savings accounts, lower fees on car loans, on mortgages, and all of that good stuff. So definitely a great alternative, locally owned by our members. So another really good setup. So credit. Why is credit important? These are just some of the reasons. Oftentimes when I'm doing this, I pose the question, why is credit important to you? So I'll put it out there to think about. And if you want to write something into the question box, you can. And questions that I will answer at the end or as we go, depending on how they fit in. So why is credit so important? Credit gives us choice and opportunity, power, flexibility, lower costs. So these are some of the reasons that I came up with based on talking with people. There are always a lot of good answers when I pose the question to a group, but credit gives you choice over where to move, right? What kind of car you want to drive, gives you opportunity. So are you able to buy that house when it comes up, or that car, or whatever the case may be? You have the power to do what you want when you have credit a lot of times, and the flexibility to do it. So credit is valuable, right? You're all here because we know that credit is important. So this is a flow chart that I created to sort of go through the process, whether you're improving credit or establishing credit. So if we start at the top and look at, yep, this is me. I currently have open loans or credit cards. So you're going to go either on the yes path or the no path, right? And so we're focusing a lot on the no path tonight, but I promise the folks on the yes path will also find valuable information. But we're looking at, how are we establishing credit? If you don't have loans and credit cards, then your credit problem, in quotes, problem, is going to be that you need to build credit, right? You need to establish credit, because if you don't have any current loans or credit cards, then even though you're paying all your bills, you don't have credit. On the other side, we're looking at, I currently have open loans or credit cards. Yes. All right. If yes, I'm going to work towards relying less on credit. I'm going to work towards decreasing my debt. But we're all going to work at the end toward effectively managing my credit to maximize my score, right? So we're all going to get there, a little different path, but we're all going to follow some of the same best practices. So we'll look through some of those tonight, and then again in 2 weeks, a little differently. Okay. So just off the bat, looking at the value of credit, we've got two lovely people here. We've got Jim and Katie, and both of them come to PFCU for a car loan. They're going to borrow $15,000. And so you'll see here I use some of the vocabulary words that we use when we're talking about credit. The principal is the original amount I borrow. So they both come in and borrow $15,000. Katie, you can see Katie's got a smiley face, if you could tell. And so her interest rate is going to be much lower than Jim's. So Katie's got that good interest rate at 2.99%. Jim is paying 10.74% interest. So certainly much higher. They both have the same term. So the term is how long they borrow the money. And in this case, it's 60 months. Same term. Their payments are going to be different, right? Katie pays $269 a month, and Jim pays $324. So if you're looking just at that month, it's fairly significant, right? More than $50 difference, but depends. I can just imagine people saying to me like, oh, 50's not too bad. Okay, right? So yeah, $50 would be great if I had in my pocket. On the other hand, we're going to look at the total interest paid. So what happens is Katie borrows $15,000 for the car. She pays back $15,000 plus the interest. So in total, Katie's paying $15,000 plus $1,168. So $16,000 car, right? Jim, on the other hand, over the course of the 5 years he pays back his loan, he will be paying about $19,400. So that's a significant amount of money different when you're looking at getting the same car. Right? We can only imagine if we extrapolate and if we looked at Jim with a bigger purchase, with a longer term, that car loan is just going to get bigger and bigger. And you'll notice $15,000 is a fairly low price for a car, unless we're getting the hoopty, right? So if we look at Jim going to a bank, so we see Katie is in great shape, right? She's not paying a ton of extra money. We see Jim, it feels like he's paying a lot. If I compared Jim at PFCU, which is what we have here, versus a traditional bank, you're going to see Jim paying back about $22,000. So everybody's getting the same car. It's just not everyone is paying the same amount for it at the end of the day. So we see the value, right? So good credit and bad credit cost the money. Oh, no hoopty, someone said. All right, fair enough. I will say that there are certain things. If you get that lower cost car and you know that it might have problems, you need to have a backup plan, right? You need to have a savings account with some money set aside in case your car breaks down. You need to be able to figure out how to get to work if you can't drive, right? So yeah, so if you get that lower cost vehicle that maybe is going to have some problems, then you have to have a couple of backup plans in place, right? So it's all about strategic here and your strategy. All right. So credit is about more than just paying our bills. You know, a lot of people I talk to say, yeah, credit, you know, you pay your bills, you have good credit. But unfortunately, it is slightly more complicated than that, right? Because credit is not only about those bills, but it's about how we manage debt. So we're looking at, and this is an important word because I'm going to be using it again and again today, credit trade lines. So what is a credit trade line? In order to have credit, you need credit trade lines. So this would be loans or credit cards. So any type of loan, whether it's a car loan or a personal loan, mortgage, student loan, any of those loans are a trade line. The other type of credit trade line are credit cards. And these are the only payments that are building credit. Many of the payments we pay every month are not reported. You pay rent, it is not reported to your credit. You pay your gas bill, your electric bill, your cable bill, your phone bill. None of those are reported when you pay them. However, these same accounts will report to the credit bureau if you do not pay them. So we have, you know, I'm not paying my cable bill. Comcast is going to report that to the credit bureaus and it's going to hurt my credit. And we'll look at what that looks like in a few minutes. But if I do pay my credit every month, my cable bill every month, well, then it's not going to help my credit, right? So we're looking at, in order to establish credit, you really do need these credit trade lines. So we're going to talk about how do you get those credit trade lines and how do you manage them. So I want to specifically spell out the differences between credit bureaus and credit reports and credit scores. So there are three major credit bureaus that collect all of our credit data: Equifax, Experian, and TransUnion. So these are the three companies. They collect all of the data on our payments for loans and credit cards and some of our personal information. And we'll go through some of the details of what's on the credit report. So these three credit bureaus collect all this information And we have the right to see that information right now once a week since COVID. So this is a new law that it used to be we could only see our credit reports once a year for free, but now we can see them once a week for free, all three of them. When you check your own credit, it does not hurt your credit score. I'm going to say that again. When you check your own credit, it does not hurt your credit score. However, when you apply for credit, it does. And we'll look at all of the ways that your credit is impacted. So we've got 3 credit bureaus, Equifax, Experian, and TransUnion, and each one creates their own credit report. There's a whole nother company that will give you a credit score. So another company in this little mix is FICO and Vantage, which we'll talk about too. So the 3 credit bureaus report all the information. FICO looks at this information and gives you a grade. So your FICO score, another scoring system that is around is called a Vantage score. We're going to talk about some of the characteristics of each of them. Both range from 300 to 850. With the higher score, the better. So the closer you are to 850, the better your credit is. What does that mean? It means you get lower rates, might mean you get insurance that you couldn't otherwise get. The FICO score is usually not free. Sometimes there's certainly exceptions, but it is usually not free. Usually your FICO score is something you have to pay for. Your Vantage score is more often offered for free. So many people are familiar with Credit Karma. Credit Karma uses a Vantage score. And we're going to look at the similarities and differences. It's great that I can get my Vantage score for free, but if the credit union is using FICO, then the scores may not look the same. So I might go in and say, like, I just checked my credit, it was a 750. And you know, you go in to get that car loan and they say, you're at a 690, right? The difference could be a different scoring system. So FICO is still the most frequently used scoring system, so we'll talk in a little more detail about FICO, but there's a lot of things in common. So you get the Vantage score for free because you have access to it through maybe your credit cards or your financial institutions. That's great because you're not paying for it. It's already in something that you are, something you have access to. So that's great. I don't necessarily recommend you go out and pay for a FICO score. The idea is you're going to learn about the things that impact your credit score here and figure out the best way to make the most of it, right? So that's the idea. Your Vantage score will report new credit within a month or two. So you might just be starting out with credit, you have a secured credit card, and you check your Vantage score and it already is boosted. So you go and get that loan, but FICO requires a 6-month credit history. I'm going to stop for a second. Questions about the scoring? We're going to look. Somebody asked about a credit boost. We're going to talk about it. Okay. And I am checking in with questions, so keep popping them in the chat, and I will either save them for the end or address them as I go. All right, so a little more information about the FICO score because it is the most important. It's the most frequently used scoring system. And I also have information I'll share with you about the Vantage score just so you can see, all right, how close is this going to be to what most of the lenders are using. So you can see from this chart, if you can't see, 35% of your FICO score is made up of your payment history. It's a huge amount. It's the biggest piece of this pie here. And Similarly, Vantage says your payment history is extremely influential. So none of these companies give us a ton of details on how they get our credit scores because they're selling them, right? If they tell us how they make them, then they're not going to be able to sell them. So it's in their best interest to keep it a little bit mysterious. So we see that 35% payment history. That's going to take into consideration, are you missing payments or are you paying every month on time? And so we'll look a little deeper at that section because it's so important. 30%, this says capacity. I'm going to explain this as how much credit you have and how much credit you're using. And so that too, we're going to get into those two sections because they're the biggest section. And the Vantage score says the percent of your credit limit used is highly influential on your score. So we're looking at how much of your credit you're using and your payment history is the two biggest pieces in this credit score. So because of that, let's talk about these most common credit score busters. So credit score busters are the things that are most likely to really screw up your credit score. The most often when I see people, they sometimes get upset, like I have this really old account. That account might have less impact on you if it's old than the fact that you maxed out your credit card, right? So we're gonna look at your payment history, that 35% of your FICO score, extremely influential with your Vantage score. So two scoring systems, they all use the same report. And that's why we're going to look at all the details of the report to sort of figure out how can we increase this score. But to understand sort of the makeup of the score first. So we're looking at a 30-day late payment has a pretty significant negative impact on your credit report. So if you are 30 days late on your payment, you're going to see a decrease in your score. It's going to be reported 30 days late, right? So what do you do if you can't make a payment? And again, if I pose this question, I know you can answer it. You call the company, right? You make an arrangement. PFCU, your credit card company, whoever the lender is, they would much rather have the money next month than not at all, which means that it's in everyone's best interest for you to call and make an arrangement. If you're unable to pay, it's been a really tough year for so many people, but you have to be in communication because the credit card companies, lenders, they're not going to do anything really out of their way unless you ask. So you really truly just have to reach out and say, this is what's going on, what can we do? And that's how you get arrangements made. So if at any point in time you're unable to make a payment or you're really struggling, make that phone call with whatever company it is, especially with your credit cards and your loans, because that 30-day late payment will have a long-term impact on your credit score. Another credit score buster, I think I need to change that name. I don't like that. So another negative to your credit score, another thing that can really screw you up are charged off accounts. So if you stopped paying something and they reported to the credit bureau and they charged it off as a loss. So for example, there was an urgent care bill that didn't get paid, hypothetically. And that company, they charged it off. They said, she's not ever going to pay us. And so we're going to claim it as a loss. So that's reported on my credit report, and it will stay there for 7 years from the last date of payment. So these negative accounts can really have a lasting impact. But on that side of things too, as time goes on, they will hurt you less and less. So the older an account is, a negative account, a debt, for the most part, depending on the debt, the less it will impact your score. So that 3-year-old Comcast bill is less important than a 2-month-old Comcast bill, right? That 2-month-old bill will have a lot more negative impact than a 3 or 4-year-old bill. The last credit score buster that I want to talk about today is high credit utilization ratio. That's a whole mouthful. We're going to go into more detail. This means that you're really running up your credit cards. And so we'll look at some examples of that, because this is probably not only a fairly easy way to end up hurting your credit score, it's also a way that you can control it and continue to manage it positively. All right, so let me know if you have questions on these credit score busters. Again, we'll go in a little more detail on the utilization ratio, but I'm just going to check in with the questions and see. Okay, so just to sort of go back for a second to FICO and Vantage Score. So Vantage Score is the scoring system that Credit Karma uses. It's not that it's not accurate. It's just that if nobody uses it, it's not as useful. So your Vantage Score is the free score that you can get many places, but it can often be slightly different than your FICO score. Your FICO score is not cheap. You might pay $60 for it. So you have to decide, you know, I say a little bit like your report is free. So if you can look at those details, and we're going to talk about all of these things tonight, about what impacts your score and what's going to lower it, you can see those details from your report and you can manage it that way. I don't pay for a FICO score. I don't recommend you go out and pay for a FICO score. If you know what's going on with your report and you can sort of monitor it that way, maybe take advantage if one of your current lenders gives you a free score, that's great too. Yeah, I mean, it's really just a matter of personal choice, which is not exactly useful. Okay. All right, so I see some good questions in the chat, and I'm going to be answering them as we go. So let's plow ahead. All right. Okay, so let's look at these details, because the idea is I'm giving you some of the tools and resources tonight to take care of your own credit, right? That means you can pull up your own credit report. I'm going to give you the website tonight. I already mentioned it, but it'll be in the handout too. So you'll be able to pull up that report, whether you're brand new to credit or not, right? We should all be checking it, and we should all be looking for fraud. So what are we going to look at when we look at our credit report? We're going to look at our personal information. And this is a good place to start checking for fraud. So we're going to look and see our name is on there, our birth date, our social security number, previous addresses, maybe phone numbers that we had years and years and years ago. Sometimes employers are on there. This is not an employment record, but sometimes employers are listed. And that's if you ever applied for something and listed the employer, an employer might be on your credit report. A spouse might or might not be on your credit report, depending on applications for things. So you're mostly looking, you know, names, birth dates, social security number, and previous addresses. You want to make sure you recognize those previous addresses, and there's no addresses that you're unsure about, because that could certainly be a sign of identity theft. So then we're going to look at your credit accounts. These are your current accounts that you have and historic accounts. So When we're talking about credit accounts in this case, we're talking very specifically about your trade lines. So any loans that you had and credit cards that you had or have will fit into this category. And these accounts can stay on for a very long time. So you might have an old account, it's been on there for, for years, it's paid off, you never missed a payment, great, right? It's not hurting you at all. But these both current and historic accounts are on there and listed. And what it includes specific details. So in your credit accounts section, you will see your credit limit and the balances on credit cards. So when it comes to a credit card, your credit limit is the amount that the credit card company says you can spend. They are loaning you that much money, right? It's not your own money, but a credit limit is how much that credit card will allow you to spend. The balance on that credit card is whatever you spend that month plus anything that you've spent previously. Your credit account section on your report also lists the payment history. So if you pay every single month on time to your loans and credit cards, that will be listed here. You will also see dates the accounts were opened and closed and the name of the creditor. So a lot of really important information in terms of figuring out how things look, right? I'm going to be able to see what my credit limit and my balances are on my credit cards. I'm going to see, did I have a 30-day, 60-day, 90-day late payment on that account? I'm going to see that all in my credit accounts section. And someone asked a question about student loans, and now I lost, there it is. Okay, so a question about student loans that are not in default. So student loans would hang out in the credit accounts section. And so student loans are one of the loans that you might have, a debt that you might have. They will work with you more than other debts that you have generally, right? You can call the student loan company and make arrangements based on your income, based on your financial situation. Right now, there are currently no payments due at this time for federal student loans. And so at this point in time, not making a payment on your student loans is not hurting you. Student loans have a little more wiggle room when it comes to making arrangements. Unfortunately, once they're in default, and default means you're not paying them at all. If you're in default, then there are some consequences to that down the road. But, that'll be we can address that at a later time. Not sure if I completely answered the question, but student loans are one of those that definitely have that conversation with them. They will absolutely work with you. And so I'll say with student loans too, yeah, I'm going to leave it at that. Call them, make an arrangement. That's my best advice. All right, so we talked about the personal information on a credit report. We talked about your credit accounts, both current and historic, and remembering that your phone bills that you pay are not on here, right? Your cable bills, your gas, your electric, your rent, none of that is included. So strictly loans and credit cards. Next section we're going to look at is collection accounts. So this is anytime you stopped paying something. So this does include everything. This includes that old phone bill, that old cable bill. It includes that old medical bill that the insurance didn't cover. Maybe you didn't have insurance. Those are all under these collection accounts. And so it's an important thing to know that collection accounts, any negative account, any account that you owe will stay on your credit report for 7 years from the last date of payment. So at that 7-year point, they're supposed to fall off on their own. It's a great idea to keep track of it and just make sure that it does come off as it's supposed to. I mentioned that, that urgent care bill that hypothetically is a collection account that will list, well, if I never made a payment, it's going to list when the payment was due, right? And it was due on the day I went, and so I didn't pay it then. And then 7 years from that date, is when that account is going to be removed. And so it should come off. If another collection agency owns that debt. So what happens is a collection agency will sell a debt to another collector, to another collector, to another collector. And in that case, the timeline for how long that debt stays on your account does not change. Your report will only reflect that, should only reflect that account for 7 years from the last date of payment. So however many collection agencies own the debt does not matter. The length of time that debt is on your credit report is based on your last date of payment. Right. And the last section on your credit report is the inquiries section. And inquiries are anytime you apply for credit. So there are two types. You can apply through credit, two types of inquiries, I'm sorry. So hard inquiries will have a somewhat negative impact on your credit score. This is anytime you apply for credit. This is any type of credit, even if it's not a credit trade line. What does that mean? That means that if you apply for a new phone and they run your credit, your score can go down a little bit, probably will go down a little bit. You know, a phone, cable, gas, electric, although I don't know about PICO and PGW, so don't quote me on them, but you know, most of the phones and cable companies, these are all hard inquiries, in which case your credit score will go down a little bit. This is very different than a soft inquiry. So a soft inquiry does not hurt your credit score. This is times when you check your own credit. That's a soft inquiry. When you are looking for when you are pre-approved for something, right? You get something in the mail, it says pre-approved for whatever. That is a soft inquiry, right? They might have looked at your credit, but you didn't apply for anything. So it doesn't hurt your score. When you apply for employment and they check your credit, that is a soft inquiry. More and more employers are using credit as another background check. And so luckily though, it doesn't hurt your score. Okay. Oh, thank you, great question. How long do the inquiries stay on your credit report? The inquiries stay on your credit report for 2 years. So not forever, they stay on for 2 years, but they only impact your FICO score for 1 year. So the idea though, the recommendation, the best practice for inquiries is don't go around applying for a lot of credit, just ever, right? Especially if you have something coming up that you want to do, don't run out and apply for credit, right? Don't apply for several different things. However, several different credit cards. It's built in, according to FICO, there is a system, both scoring systems build in a plan that you can apply for several car loans in order to shop around, with that really only having a one-time impact on your score. Same thing if you're applying for mortgages and you want to get the best rate possible, so you apply for more than one. Then those two are only going to really have one hit to your credit score. Anytime a company is offering you something that you didn't apply for, then that is a soft inquiry. Okay. All right, questions about what's on the credit report before we move along? Okay, we'll keep going. And I do see some really good questions, so I will be getting back to these questions at the end. Okay. So now we're looking at, all right, I'm starting out, I want to do this right. I want to build or establish my credit in a positive way. I currently have no loans and I have no credit cards. I might have debt, but I might have that old bill that I mentioned, but we're not talking about that at the moment. We're only talking about building or establishing credit. So what do we do? So my favorite way to build or establish credit is it's a product that we have called a credit builder loan. And there's been research around credit unions and credit builder loans, and they're excellent. So we'll talk a little about that. We'll talk about secured credit cards as another way to build credit. And then I will get into a little of the Experian Boost and the Ultra FICO. I will say that Experian Boost and Ultra FICO are not enough. So interesting and new and maybe exciting, but we're not there yet, which doesn't mean you don't want to take advantage. But anyway, we'll get into those a little bit. Okay. So for building credit, the credit builder loan is, this is something that we offer at PFCU. So this is showing an example of a $250 loan. And this is a 12-month term. So we talked about term, that's the length of time that you have the loan. And this is great to build or establish credit. Now the Federal Trade Commission did or the CFPB, I can't remember, one of those wonderful federal agencies that protects us as consumers did a study of this. I think it's the CFPB actually, Consumer Financial Protection Bureau, and I'd be happy to send you a link to the study if you email me. They did this study that showed that people who do not currently have loans or credit cards and have a credit builder loan from a credit union, very much like this, go from basically having no score towards the end of their payment of having a score of 620. Now, 620 is not the end all be all, but it is absolutely on your way to getting what you want. Okay, so somebody already said they have a credit builder loan and it helped their score a little. Okay, great. So this is especially good if you do not have loans or credit cards, and that's what this study found, right? So from PFCU's point of view, I can tell you that we report these payments. So let me explain how it works. What happens is, and you can see the little visual, if you can see it, is kind of helpful. I like that it's sort of frozen in a block of ice. So what happens is with this credit builder loan, PFCU supplies the money. However, you can't actually spend it, which means you know, it's very hard to screw this up. So rewinding, PFCU, you apply for a credit builder loan, PFCU deposits $250 into your savings account. That money is frozen. On paper, it looks like you got a loan, and we start reporting that you got a credit builder loan for $250. Now, that loan, of course, starts to be due the next month. So assuming you borrowed $250, you have to pay back about $28 a month. That's way too small on my screen for me to see. $20 a month? So you pay about $20 a month on this loan every month. Every month you pay, we are reporting, yep, you paid your loan on time. Yep, you paid your loan on time. Yep, you paid your loan on time. Now, if we remember, FICO doesn't start reporting this until 6 months. But once it reports, you've got 6 months positive credit history. So you're holding that $250 that we let you hold. It's frozen. You can't do anything with it. Over the course of this year, you pay us completely that whole $250 back, plus about $5.41 in interest, right? So in total, you pay $256 to the credit union. Now we have that $250 that's been sitting in your account. Now that money is not frozen, and you can see, again, the visual is better than my explanation. That money is thawed. You can spend it. That $250 belongs to you. So what did we do? We traded. So what happens is we put the money in your account, you paid it back. Once you totally paid it back in full, you can keep that original $250. So what do? You're establishing a loan payment every month. You're paying your loan in full and you're getting credit, literally, for paying that loan. because it's reporting to the 3 major credit bureaus that you paid a loan on time. At the end, you also saved $250. So once that money is unfrozen, you can do with it whatever you like, right? You can do these loans between $250 and $1,000. There is a small amount of interest, I mentioned that. So if you borrow, if you get this loan for $250, by the end you're paying just under $6 total in interest. So super affordable and a great way to sort of force yourself to save. Because what I know about people from my 10 years of doing financial education is that people pay their bills. They're not always good at saving, right? So in a way, right, we're saving and building this credit at the same time. However, let me be clear that you don't want, this is not a regular savings account because you can't touch this money until it's totally paid off. So before you rush out and do this, you want to make sure that you have some sort of, savings in place, a little safety net, a little wiggle room. Okay. So, I would say start with one, do a year's worth of credit builder loan and see where you are. Maybe the next step then would be maybe another credit builder loan or maybe something like a credit card, but maybe this time you're eligible for an unsecured credit card. So as much as I steer people away from credit cards are a very impactful way to build credit. So that's what we'll talk about next. So I love the credit builder loan as a first step because what you don't do with a credit builder loan is you don't accidentally spend too much money. You just continue to pay it. I did the credit builder loan a couple years ago, and when I did it, I did payroll deduction. So my direct deposit, of course, as an employee, but also as my choice, goes into my PFCU account. And I did payroll deduction. So $9.80 got transferred every 2 weeks. And I didn't ever think about it. So a great question about paying towards your student loans, paying towards any loans or credit cards that are open will absolutely have the same impact. So if you have loans, student loans, and you pay on them, then you don't need this credit builder. You just pay on those. The question specifically that this person asked is paying on student loans, even if deferred, have the same impact? I don't know that answer. That's a great question. I don't know. Let me research and get back to you. So we'll find out that answer. But if your loans are active, definitely paying on them in this way will have a positive impact. Another question about the credit builder loan is it a soft pull or a hard pull? We don't pull credit at all for the credit builder loan. So that's great. So it has no impact. So when you apply for it, you're just saying, yeah, I want to do this, right? We're probably, I believe we need proof of income because of course you need to be able to pay it, right? You need to have income in order to qualify for the credit builder loan, but is not based on credit. All right, so that's the credit builder loan. This is information, and if you're interested in the credit builder loan as a way to build credit for you or someone you know, you can apply. You cannot do it through our website, and that's an important distinction because if you did it through our website, it would go through our credit system, and we're not pulling your credit. So you do have to either call and do the credit builder loan over the phone or go into a branch in order to apply for it. So that's a good, you guys, some of these questions are really excellent. I appreciate the, especially because I've been stuck away from people for so long. Okay, so another way to build credit is through a secured credit card. So my favorite way is the credit builder loan, but another effective way of doing it is a secured credit card. And a lot of people, this is the most common way that I see for people to start out. Had another question about income. Income is income, wherever it comes from. Income is income, whether it's from Social Security or SSI, or if it is usually Social Security or SSI, it is permanent, or permanent. Nothing's permanent, right? But yeah, unemployment is tricky because unemployment comes and goes, but usually, you know, income is income. And another really good question about the credit builder loan. Credit builder loan works best for people who are new to credit. If you're someone who already has loans and credit cards, then focus on those. And don't worry about the credit builder loan. Credit builder loan works really, really well for people who don't have any credit yet. I'm not going to say it doesn't work for other people, but it works best for people who don't have credit. And I want everybody else to focus on their open loans and credit cards and really work on those otherwise. All right. Okay, I'm going to take a breath after that, and then we'll talk about secured credit cards. So secured credit cards are another way to build credit. Secured credit cards are secured with your money, usually between $300 to $500. So you need to put up money in order to have a secured credit card. These almost always have an annual fee, so they're going to charge you, right? It's a cost of doing business. They often have some credit or income qualifications. You always, and we're going to look at this next, this credit utilization, and I know there were some questions about this before. We're going to look at this in a minute. 30% of your credit limit. With the secured card, so this is the perfect world where we're just starting out and we're starting it on the right foot. We want to pay off the balance in full every month to avoid paying interest. So through the magic of credit cards, if you charge $50 and pay $50 off, it only will cost you $50. If you charge $50 and pay $25 off, you're going to have to pay the rest of that $25 back plus interest. So we'll look at an example of that in a minute, but first let's look at this credit utilization ratio. What does that mouthful mean? So I mentioned before, credit is about managing debt. Payments on loans and credit cards are reported. We said all this before, but here's the credit utilization ratio. You're looking to keep the balances on your credit cards low to improve your score. So with card A and card B down in the little chart, card A has a credit limit of $1,000. That means Capital One said you can spend $1,000. So what did I do? I spent 800 of it. Not necessarily right away, but I still did it. So what is the ratio? When I look at how much I spent, how much of that pie did I eat? I've got $1,000 pie, how much I ate? $800 of it. So I've used 80% of my available credit. That 80% is really gonna hurt my score. That's credit card A. Now credit card B has the same limit. So they said, here you go, you can spend $1,000. It doesn't mean I have $1,000, it just means I can spend it. That's my limit. What I do is I spend $100. Now that's only 10% of my available credit. So that's a very low utilization ratio. So that is really good. So we're looking at that utilization ratio to be under 30%, at the most 30%. So in this case, my credit limit's $1,000. I should always think, never put more than 300 on there, because then my score is going to start to be lower and lower and lower. The other thing I want to tell myself though is even more as important, if I cannot pay it off, I should not charge it. So this is how we're all supposed to be taught to use credit cards, although not all of us are, right? If I cannot pay it off, I shouldn't put it on my credit card. I understand sometimes we use credit cards for emergencies. In this case, we're talking about building it and best practices. So if we're talking about starting out with a best foot forward, we're only going to spend something small and then we're going to pay it off in full. Because the reality is here with credit card A, maybe I cannot pay that $800. So what happens? What happens is I pay interest on whatever is left over. It costs me money. My score goes down. But even if I do pay off that whole 800, I ran up the bill that month to $800. So just by running it up and using that much credit, I am hurting my score. So if I have a secured credit card and my credit limit is $300 and I spend $200, even if I pay it off, my credit score can suffer. So you really want to keep that balance all the time low. Yeah, so even if I pay it off within the same month, now it depends on when they report it, but I would be very cautious, right? So I would say, don't ever let that balance get high, even though you plan to pay it off. How is it that people get into credit card debt? And this is sort of the cautionary tale, especially, if we're looking at how you end up in debt, or how to avoid it. I have a chart up here, and then I'm going to pause and we'll talk through a few questions about the utilization ratio again. But this just shows how the balance sneaks up on you. I have this credit card, and month one, I charge $100. And so if you follow across the chart, you can see my balance is $100. Month two, I paid $40. I feel really good because I pay more than the minimum, but I didn't pay it off. So what happens now is that the credit card adds $3 in interest. And of course, I charge another $100, right? So at the end of that month, at the end of month two, I owe $163. All right, it's fine. I'm going to pay more than the minimum, so I pay $40. That month, they're going to add my interest. It becomes even higher because the higher my balance is, the more interest they charge. I charge $100 again. It's only $100. Now my balance is $227. I pay $40, I charge $100. And that's going to be my pattern for 2 years. And at the end of 2 years, you can see at 25 months, I've got an almost $2,000 balance. And that credit card really just snuck up. And this is what I see that happens to people. And you can see by that time, the interest payment is $28. So that $40 is barely even touching. It's barely even touching the amount I owe, because 28 of that $40 is going to the interest. And even if you don't understand the math in this, because it's made in a way that's very difficult to understand, and the credit card companies know this, the rule of thumb is if you cannot pay for it, don't charge it, right? The other rule of the next best thing is to stop using the card, right? And this is when we get into managing our credit. So we can see, and I don't know if this is relatable to anybody, should ask that question in a poll, but I feel like I often show this and people are like, totally, that's me. I didn't go crazy. I didn't run it up all at once, but little by little, I got to a place that I have way more credit card debt than I want. And so it's really easy to fall into this trap. All right, so I'm going to take a second and look at the questions here because I know there are a few about the utilization ratio. Okay, so a great question. Should you think of that 30% as the goal? Should you use at least 30% every month? No, that's an excellent question. I would say, again, if we're looking at like best practices, I would say choose one small bill to put on the credit card. We're looking at building credit, right? So I'm gonna say I pay, Spotify is my one of my smallest bills. Pay for Spotify, it includes Hulu, I think, whatever, and there's 3 of us on the account, blah, blah, blah. It's $16. Feels like too much. That's why I'm saying it like that. But if I have a new credit card, if I have that secured credit card and I'm looking to build credit, the only thing I'm going to do is have that Spotify bill be charged to the card. That tiny balance is going to be even better. So the lower my balance is, the better. Now I have that $16, that's all I used of the 300 available to me, and I set it to automatically pay it off. The reason I like to use a small bill to build credit, and notice how small the bill is, right? It's not my, my electric bill, which is now $109. It's a little one, it's 16. And that's very intentional. And it's intentional that because it's a tiny percentage of my available credit. That's a really good thing for my score. The other reason the bill is important in this case is that I'm not swiping. My browser isn't saving my credit card information because I'm only using it to pay the bill. I find that it's very easy to swipe once. Oh, I just buy, groceries once a month. Then I start to buy groceries twice a month with my credit card. Then I buy them every week with my credit card. And now all of a sudden I end up with this debt. So I really like the idea of if you're establishing credit or reestablishing on a new credit card, you really want to do it right, just using that once a month, a small payment, pay it off in full. Okay. I mentioned that I will talk about Experian Boost and Ultra FICO. I will briefly. There's a lot of great information. I'm going to share my email address, and I have NerdWallet is a website that I like. They have a really good explanation of Experian Boost and Ultra FICO and what they're used for. So, all right, so we talked about the credit report, we talked about the credit scores and building credit. This is another way, and it's a little bit of a non-traditional way, or it is very much a non-traditional way that people are building credit. And you might or might not have seen this advertised. I know a couple of people mentioned it already. Experian Boost is a way that Experian, so Experian's one of the 3 credit bureaus, is allowing you to boost your credit score, boost your thin file, you don't really have any credit established, by using your utility bills, gas, electric, whatever, phone bills. So this only considers positive information, which is good, right? So if you have missed payments, it's not going to hurt you. It's only going to help. However, not everybody uses Experian, right? Not all lenders use Experian. It's not going to improve if someone's looking at an average of your FICO scores through the 3 credit bureaus. It's not going to impact TransUnion, and it's not going to impact Equifax. It's possible that this will continue to catch on and allow maybe for a slightly more equitable credit score. But for now, this is what it is. So you can opt in to add that. You can do that. So you can check out with Experian if you're interested in learning more about that or in doing that for yourself. So it can be a good tool. It's not really everything for everyone, in other words. It's not a bad thing, but it will help only in certain circumstances. Your Ultra FICO, so another score, sort of looking at a way to boost your score. The idea is they're sort of giving people credit for their banking history, because a lot of people, and I see this all the time, have just not had credit either at all or recently. But you have money and you pay your bills and you have employment and you have all of that stuff coming in and out as it should. Maybe you're a good saver, maybe you have that direct deposit. So Ultra FICO will allow lenders can use this. They can opt in to be able to see additional information on you. It's meant to enhance your FICO score. Again, it's supposed to have more of a positive impact than a negative, and sort of open up credit to more people who maybe have that thin file, who don't have any credit established. And currently, the only credit bureau using it is Experian. So once again, if you are dealing with TransUnion or Equifax, then those companies are not using this Ultra FICO at this time. But it'll be interesting to watch it as it develops and to see if we're moving in different direction from some of this stuff. Okay, and someone commented that, we're not PFCU, Experian Boost. Oh, Experian Boost doesn't recognize the credit union. Yes, so Experian Boost is going to be for utilities only versus Ultra FICO. And Ultra FICO is going to depend on the lender using it. So you don't opt in, but I think the lender opts into that. So again, check out Experian has some good articles about all of these to learn more, but I think we're at the early stages of this having sort of a bigger impact for many of us. Not a bad thing by any means, and I think hopefully it's on the side of consumers to give people sort of a more equitable credit in a very unequal and non-equitable system. All right. Great spot to talk about Clarify. Clarify is a local nonprofit. They are a local nonprofit partner of PFCU. They are a financial counseling agency that can help you improve your credit, reduce your debt, avoid foreclosure. They're wonderful. Most of their services are free. The only things that are not free are things that will require you paying costs in court, like bankruptcy for the most part. There are certain fees for things, but in general, Clarify is an outstanding place to get your credit, to get credit counseling for free. And they're excellent. And you can call and schedule an appointment on over the phone, or you can go into their website and schedule through their portal. And they are talking to people and taking appointments over the phone right now. And so they're an excellent resource. I really can't recommend them highly enough. In fact, PFCU likes them so well that like I said, we've partnered with them, but they are open to anybody in the city of Philadelphia and the surrounding areas. They have 20 offices in the southeastern Pennsylvania, Delaware, New Jersey area. So they're really wonderful. They've been doing this work for a long time locally, and as a nonprofit, they are really in business to help, and they're not making money off of you, which is why that credit counseling is, no cost. They can help you manage. And really, a lot of people, including, a lot of the questions I see tonight are very specific to, this is what's going on with me. What do I do about it? Well, Clarify can help you because they'll really take a look at your personal credit report and come up, and then you will come up with a plan with their support to decide what makes the most sense for you. Okay. So we're looking at our credit report, and when you're looking at it, you see, you want to check for all of these details and make sure they're all accurate. How do you dispute errors on your credit report? So this is something, I know there are companies and other things, and people advertise on social media, on the light posts, for goodness sakes, on the traffic lights. We can help you with your credit, right? At best, all they're doing is filing disputes on your behalf, which you can absolutely do for yourself. That's at best, right? Do not pay anyone to help you with your credit. So this is what you would do for yourself. So what you do is you get a hold of your credit report. When you have your credit report, then you're going to, and you see an error on there, you want to file a dispute. So you can file a dispute in two different ways. You can file online or file over the phone. You want to file disputes. You see the account, it's very simple. The online process walks you through it. The phone process walks you through it too. So you click on the account, you want to dispute, and then you choose one of the reasons that you're disputing it. And they give you options. Maybe you don't recognize it, maybe the amount is wrong, maybe the date is wrong, whatever the error is, it's your right to dispute it. But no one else is going to dispute it besides you. So it's also then your responsibility to take a look at it and to make those disputes. You can also dispute over the phone. So on your credit report, once you pull it up through annual credit report, you'll see those dispute numbers, and you can do that on your own. And call each of the credit bureaus, and again, it will walk you through the process. One really nice point here is that collection accounts that don't respond to disputes are deleted, right? If they're not coming and verifying the information, then that account is deleted. So that's really useful information to know. Sometimes we get lucky when we file disputes and that collection account doesn't respond, and that account is deleted. If you have proof, whenever possible, it's a great idea to provide the proof. So maybe this account didn't belong to you and you can prove it. Maybe the insurance company paid it and you can prove it. Great. So you can submit those online or you can mail them in if that's the case. So from here, we're going to look at the next steps. And this is where we're going to pick up on the next section in 2 weeks on reducing our spending and making a plan to pay off that debt. So that's what we're going to focus on. All right. I do want to sort of just run through these before so that's sort of the end of the new material. I'm going to go through these tips one more time that we talked about because we're talking about building credit. And so we want to make a plan that we're not relying on credit for monthly expenses or emergencies. So that means we're saving consistently, right? And building up that savings account. And you know, there's certainly a lot of reasons that, right? If you don't want to run up that credit card bill and end up paying interest because you had an emergency. Another sort of best practice here, the goal is going to be to pay off your credit card balance in full every month. You want to keep balances on credit cards low at all times. You want to build your savings to protect your future credit. Use annualcreditreport.com to check your credit report often, and don't pay someone to help with your credit.